I think it's pretty unanimous that every single one of us wants to ride a supernova. What's a supernova, you ask? I'm not talking about when a star explodes its guts across the universe. I'm talking about when the crappiest, most worthless stock somehow increases 3 to 4 times its original price in a single day, which can easily lead to unfathomable gains in such a short period of time. Something the cosmological and the stock market supernova both have in common is that they explode at one point. One with a spectacular show of light and fire, and another with crippling losses and in some instances irreversible. In this video, I'm going to break down the structure of supernovas as they develop, what causes these large, seemingly ungodly amounts of upwards mobility and how you can find them, and subsequently profit from them as well. First, we need to categorize a supernova. What would separate the normal rally or trend from the elusive supernova setup? There's no real metric I use to categorize a normal spike from a supernova, since every supernova starts as a spike or an influx in irregular volume and momentum. You have to be watching every potential runner and slowly separate the wheat from the chaff. The sort of recipe I use when it comes to finding the potentials and the ingredients are very straightforward. First is a catalyst within the last 24 hours or within a trending sector. Number 2 is the short float percentage. Number 3 is the gap up, and number 4 is a daily chart near or exceeding 52-week highs. The catalyst is going to be the news or press release that attracts the initial influx of new eyes into the company. This is the bait, and you'll usually see them being released in the pre-market or after hours trading, but in some rare occurrences, they are released during trading hours, usually accompanied by a halt. You will have a multitude of catalysts or news types, but mostly they fall into 4 categories: earnings reports, contracts, FDA approvals and trial news, and merger agreements. You have to break things down very simplistic, where your analysis is purely, is the news good or bad? For example, a company releases an earnings report in the extended hours trading and the report shows an improvement in earnings per share and it beats analyst estimates, then I would call that positive. You could go deeper into things by reading the SEC filings, but I guarantee you it will make no difference because people buying into supernovas and big runners aren't looking at the minutia of reports. They are looking at percentage gains and movement. The catalyst also will become a way to avoid the infamous pump and dump that can develop. For example, if I see a stock has gained 50% in price overnight or even within a 24-hour time frame, if there isn't any active news or catalyst, then I'll be avoiding it. Whatever is moving that stock is beyond your sight line. Could be promotional material circulating, email and telemarketing pumping the stock up. Even in recent years, large stock educators and their massive chat rooms can easily manipulate a stock and cause huge runs to develop. If you can't pinpoint the real reason why the company is running, then you probably should stay away. You're just going to be at the mercy of when the promotion stops or when the guru tells his large group to sell and you can't react to something you can't see. Keep it simple. Look for news within the last 24 hours and try to coordinate the release with the spike in price. And boom, you found the bait. Only in rare cases I will allow exceptions to the rule, which is in the situation that you have sympathy pumps. Sympathy pumps are when you have a company that takes off to some ungodly level, and then a company situated in the same sector or having dealings with the larger mover starts to run as well. The perfect example of this is to look at the relationship between SPI and SUNW. That morning, SPI had a nice gap up in the morning, over 200%, which was already ridiculous, but the fun doesn't stop there. The news to cause this reaction was SPI was starting an EV vehicle subsidiary, which would pit the company in competition to Tesla, which is the most popular EV company on the market right now. Since EV was hot and Tesla recently made a record run to highs, people ate up SPI, and it didn't stop till the company reached $46 per share, even though beginning in the pre-market in the dollar per share range. Now, the company SUNW had no press releases that morning, but since they were in the solar sector similar to SPI, a lot of the action spilled over to that stock. No news, but gains over 400% before it utterly collapses. Just like the cosmological supernova, which births other stars, these supernovas also create other winners as well. Just having good news on the surface isn't enough to cause these massive runs. You need a stock that its inner workings are ready to pop like a can of biscuits. When I personally look for a great opportunity, I want to make sure that it's saturated with short sellers. At this point, we all know that short sellers are those who bet against stocks to profit from price downturns, essentially selling shares first and buying them back for a cheaper price to make the difference. This is very prevalent in companies that have bad fundamentals, bad news reports, and just negative chart patterns. Now, sometimes this can easily get out of proportion when you have an overcrowded short, where too many people are biased in the same direction. A good way to find this is by looking at the short interest of the stock. It's expressed in a percentage of shares that are shorted but haven't been covered yet or open short positions. The larger the percentage is, the more negatively biased you will have, but also the flip side is this leads to larger and more aggressive upside moves. Remember, shorts can lose money as prices go higher, which they will need to cover or buy back those shares. As the shares are bought back, this will cause the price to increase and new buyers will see a spike in the price as an opportunity. Now you're seeing the vicious cycle that can develop on the upside, which is the genesis to a lot of supernovas. You'll use short interest in combination with your watch list metrics. What I look for in the morning of trading are companies with 15% or more in gains in the extended hours and short float percentage above 20%. With that morning gap up developing, the swinging short positions are going to wake up to a loss right out of the gate, which can easily turn into a lot of coverings out of the gate and the squeeze to develop. That recipe can easily get out of control as coverings and new traders buy up the run. Only time will tell, but if you're there at the open using what I taught you, you can easily be in the right place at the right time for a supernova to develop. Now, I want to elaborate more on the gap up itself. It's one of those ingredients I mentioned earlier in the supernova recipe. The reason I favor gap ups is because they knock out two birds with one stone. First, the vast majority of gap ups are pushed by catalysts being released in the after hours of the previous day or the pre-market of the day of trading. You will see those early buyers are going to be attracted to those releases. Secondly, since gap ups are the genesis of a lot of small cap trading strategies currently, it will gather lots of attention, so the volume and liquidity of the trade is going to be very high, which is a good thing. Rarely will you find an illiquid gap up, since if people are willing to buy earlier and utilize special brokers and special orders to gather extended hours trading action, then you better believe the common retail trader will be waiting right at the gate to take action as well. Another thing to look at is the percentage of the gap up that the company is at open. Larger percentages will put a lot of uncomfortability in the trade. Prior holding longs will be making huge returns, so there will be incentives to sell at profit. Prior holding shorts will be getting slaughtered the higher the company gaps up, which they'll either look to re-short or close out that loss. This all culminates at the open of the day, where you'll see very large price swings up and down as shorts and longs battle it out, and the candlesticks can get very elongated and overstrung. A lot of emotion will be running wild. Sit this time out and analyze and look for consistent direction. A true runner in supernova will be able to hold its gains and trend candle after candle. I advise 5 minutes from the open at minimum to set out and analyze direction. If your reason for buying into the trade is because one large candle pops, then you will lose fairly often, and we definitely don't want that. Last but not least, the final thing I look at is the yearly chart, or really any historical chart that expands the last 3 months to a year of trading. This is something that is grossly overlooked because it's very easy to get tunnel vision on the intraday trading moves and forget the historic relevancy of the setup itself. There's a lot to look at on the daily chart: past runs and crashes, patterns also. What I'm looking for is companies coming from large downturns in the price, consistently selling off over the past weeks. This will bias the trading base to short heavily, and if you remember what I said before, the short float percentage will be dangerously high in the 20 to 30% range. An overcrowded short setup like this can really take off in the morning, so if news and a gap up is part of the equation, then be patient and look for the squeeze to develop. Also look for companies exceeding its 52-week high or yearly high levels. I like companies that are pushing out of range and setting a precedent. A tip to remember is when companies are breaking those 52-week high levels, the companies will usually release some type of PR to capitalize off the run, and other publications will talk about them, giving lots of news circulation, which will add fuel to the fire. The breaks of highs will also open up the ceiling of price. You will see with lots of gaps that they usually get thwarted or deflected at prior highs and resistances that are historically relevant. The highest ceiling is always the past yearly high. So once that point is broken, then there's a lot of room to grow, which is a good additive to an already bullish upward stock. If companies don't run straight out of the gate, that's fine. Really, that's preferred for me since there's too much noise in that area anyway. If you decide to trade a supernova, there will be much more emphasis on disciplined stop losses and taking gains in the normal interval. The downside potential will be much quicker than the upside in 95% of the cases, so you have to have a stop loss ready for any downturn. Also, you should never, and I mean never, look to hold these runners. The best course of action is to incrementally trade them. Holding these, sooner or later you're going to run into holds, where the upwards movement is artificially stopped for 5 minutes or sometimes more. This is what we call circuit breakers, which happens when volatility gets too high. Getting caught in a halt is the most stressful deal, especially if it's already ran a huge amount and the sellers are starting to stack up very quickly. The longer the halt, the more likely previous holders will look to dump the stock, and you'll end up finding yourself back to square one, if not a huge loss once it opens. Just aim for the normal gain percentage in association to risk. If I'm risking 2% of my stop loss, then I'll use a 2-to-1 risk-reward ratio and have a 4% target to sell. Now where you become more dynamic is where that 4% target is sitting. You only sell half your holdings and let the other half ride to average the gains higher. Another push of 4% and I'll be dumping all my shares at that point. It will seem like you just scratched the surface, especially when a company is up 400% on the day and you only grab 6% of profit and some guy on Twitter doubles his account and you feel left out. The goal is sustainability, and I will guarantee you that someone that doubles their account on one stock had all their eggs in one basket, which is a big no-no when it comes to risk management. Use these tips to better be prepared for the next big runner, and I'll see you on the other side of the trade.